Imagine for a moment you're an ambitious entrepreneur. Maybe you've got this brilliant idea and you're looking to raise capital. Or perhaps you're on the other side. You're a seasoned investor, always eyeing new opportunities. How do companies actually get their securities, things like stocks and bonds out there into the market? And what about all those complex rules and regulations? Well, today on the Deep Dive, we're going to try and cut through some of that complexity. Our mission, to explore the frankly intriguing world of offerings, exemptions, regulations, and municipal bonds. We'll unpack the different ways companies raise capital. Some are surprising shortcuts, actually, allowing them to get securities to market without the full, often costly registration process. But here's the catch, right? These shortcuts, they come with their own intricate sets of rules. So we'll dig into who can issue what, who can buy it, and why these differences really matter, especially for you if you're curious about how the financial world, really operates. I'm genuinely eager to explore how companies navigate these different lanes, you could say, on the financial highway. I mean, the time and cost savings these exemptions offer issuers can be enormous. But, and this is critical, we'll also highlight the protections that are still very much in place for investors.
Yeah, and what's really at the heart of this whole discussion is this fundamental tension in finance. You're balancing the need for market efficiency, making it easier, faster for companies to get capital with robust investor protection. It's a constant balancing act. And you hit on a really crucial point there. Even when securities aren't fully registered, they are never completely unregulated. They always remain subject to the anti-fraud provisions of the Securities Act of 1933. You can think of that as the core, truth-telling rule. It means even if a security isn't fully registered, you still can't lie, you can't mislead, you can't omit crucial information when you're selling it. That's just bedrock for market integrity.
Okay, right. So let's start with a basic concept then. We hear a lot about companies having to register with the SEC to sell securities publicly. But then there's this idea of exempt securities. Can you walk us through what that actually means? What types of securities fall into that bucket?
Sure. Yeah, a critical piece of market regulation revolves around these exempt securities. These are specific types of securities where the SEC has basically said, okay, these don't need the full extensive registration and prospectus treatment under the 33 Act. The exemption is mostly based on who is issuing it or the type of security itself. The SEC has a pretty clear list. It includes things like U.S. government and U.S. government agency securities, municipal securities, which we'll definitely dive into more later. Securities issued by nonprofit organizations are also on there, and short-term corporate debt, like commercial paper. But there's a key limit, maximum maturity of 270 days. That short time frame generally suggests lower risk, used for very immediate financing needs. And finally, securities from domestic banks and trust companies, and also those from small business investment companies, they're exempt too.
Okay, so for the issuers of these specific types, that means, like you said, significant time and cost savings, bypassing that big federal registration process. But just to be absolutely crystal clear, even with these exemptions, that core truth-telling rule, the anti-fraud stuff from the 33 Act, that still applies to all of them, no exceptions.
Absolutely. 100% correct. No matter what, that baseline rule, that fundamental investor protection, it's always in place.
Got it. Okay. Now, you mentioned sometimes the exemption isn't about what the security is, but how it's offered. This is where it gets really interesting, I think, because it opens up different pathways for companies. Can you tell us more about these exempt offerings?
Right, exactly. This brings up how capital can be raised more efficiently, without a full public offering. And a prime example here is Regulation D. That governs what we call private placements. Now, for an issuer's private placement to get this exemption, there are generally 4 key conditions. First, the issuer needs to have a reasonable belief that the buyer is a sophisticated investor, meaning basically they're experienced enough to evaluate the risks involved. They understand the deal.
Okay, so they know what they're doing.
Pretty much, yeah. Second, the buyer has to have access to the same kind of financial info they'd get in a prospectus. Usually this comes in a document called a private placement memorandum, or PPM.
Right.
Third, the issuer needs some assurance the buyer isn't just planning to flip the securities quickly. This is often done through an investment letter or maybe a lockup agreement. And fourth, crucially, the securities can be sold to no more than 35 non-accredited investors.
Ah, okay. That non-accredited investor part immediately makes me wonder, what exactly defines an accredited investor then? Because that sounds like a really key distinction.
It absolutely is. It's crucial. Because for private placements under Reg D, there are no restrictions on the number of accredited investors you can sell to. 0 limit. So who are they? Well, an accredited investor could be a financial institution, like a bank, or a large tax-exempt plan, maybe a private business development company. It can also be people high up in the issuing company directors, executive officers, general partners. Now, for individuals, there are two main ways to qualify. Either you have a net worth of at least $1 million.
$1 million, okay.
Yeah. But importantly, excluding the value of your primary residence, that doesn't count.
Uh,
Or you have a gross income of at least $200,000 for each of the past 2 years, or $300,000 combined income with your spouse, and you have a reasonable expectation that income level will continue. So yeah, typically individuals or institutions with significant financial means and presumably experience.
That's a really clear breakdown, thanks. So if you're one of these investors, accredited or one of the limited non-accredited ones, buying these private placement securities, are there any visible signs that they're unregistered? I mean, you can't just sell them on the open market immediately like regular stock, can you?
You're exactly right. You can't. Shares bought in a private placement actually carry a physical restrictive legend. It's printed right on the certificate. Think of it like a big stamp saying, hold on, this isn't standard public stock. There are rules about selling me.
Right.
This legend clearly states the securities haven't been registered with the SEC, and they aren't eligible for resale unless that legend gets removed. And that removal process often happens under a specific SEC rule, Rule 144. So Rule 144, that's the regulation governing the sale of both restricted stock and control stock. Restricted stock is what we just talked about, unregistered stock, typically from a private placement. Control stock is a bit different. It's registered stock, but it's been acquired by a control person.
Like an insider.
Exactly. An officer, a director, someone owning more than 10% of the company, even their family members count. And interestingly, even if that control person buys registered stock out on the open market, when they go to sell it, they still have to follow Rule 144. It's a key safeguard, really, against insiders potentially, dumping large amounts of stock and disrupting the market.
Okay, so that implies there's a specific holding period for these stocks that you can't just buy them and immediately sell.
Precisely. Rule 144 imposes holding periods. It's to make sure these shares aren't just being quickly flipped. For restricted stock, if the company files reports with the SEC, a reporting company, you have to hold it for 6 months.
6 months.
If it's a non-reporting company, that holding period stretches to 1 year. Now, for control stock, there isn't a mandatory holding period like that. The restrictions come in different ways, mainly through volume limits on how much they can sell at once. Now, when an investor, either holding restricted or control stock, wants to sell, there's a filing requirement. They generally have to file Form 144 with the SEC. This happens right when they place the sell order with their broker. And if the securities aren't sold within 90 days of filing that notice, they need to submit an amended notice. But there are important exceptions. You don't need to notify the SEC if the sale is pretty small, like less than 5,000 shares, or the total dollar amount is $50,000 or less.
Okay. That makes sense for small transactions.
Yeah, and this also gets to an important point about not disrupting the market. Rule 144 sets a volume limitation on how much stock an affiliate, that's our insider or control person, can sell over any 90-day period. For stock listed on the NYSE or NASDAQ, the maximum they can sell is the greater of two numbers, either 1% of the total shares outstanding or the stock's average weekly trading volume over the past 4 weeks, whichever number is bigger. So, quick example. Company has 7 million shares out. Average weekly volume recently was 60,000 shares. 1% of outstanding is 70,000 shares. Since 70,000 is greater than 60,000, the affiliate can sell up to 70,000 shares in that 90-day window.
Got it. So it prevents a massive flood of shares from insiders hitting the market all at once.
Exactly. It prevents them from potentially driving down the price unfairly. It's a key protection. And, crucially, non-affiliates, regular investors holding restricted stock, not insiders, once they've met their holding period, that's 6 months or 1 year, they face no volume restriction. They can sell all their shares if they want.
Okay, now here's a bit of a twist I find interesting. We've talked about private placements happening before a company goes public, but I've heard of something called PIPE, private investment in public equity. That sounds, well, counterintuitive. A private placement after an IPO. How does that work?
It does sound a bit backward, doesn't it? But yeah, it's a way for companies already trading publicly to raise capital. With a PIPE offering, a broker-dealer helps the public company distribute restricted, unregistered securities. They sell these to a small group of accredited investors. Often hedge funds are big players here. And these investors usually get the securities at a discount compared to the company's current stock price trading on the exchange.
Ah, so there's an incentive.
Right. And what you often see is these PIE investors hold the restricted shares for a relatively short time. Once the shares get registered, meaning that restrictive legend is removed, they tend to resell them pretty quickly into the public market, hopefully capturing that profit from the initial discount.
So Rule 144, it's quite detailed, clearly designed to control how these restricted shares enter the market. But is there, like, a faster track, a way to sell restricted securities to really sophisticated investors without navigating all the conditions of Rule 144?
That's exactly where Rule 144A comes into play. Its whole purpose is to create a more liquid market for private placements. It allows sales of restricted securities, could be equity, could be debt, from U.S. or foreign companies directly to highly sophisticated investors without needing to meet all the Rule 144 conditions, like holding periods or volume limits. These securities can be immediately resold, but only to other qualified institutional buyers, or QIBs.
UIBs. Okay, there's another acronym. Sounds like an even higher level of investor sophistication. What exactly defines a QIB? Are these just super wealthy individuals?
That's a great question. Think of QIBs as the biggest players, the institutional heavyweights. To be a QIB, an entity needs to pass a three-part test. First, only certain types of investors qualify. We're talking insurance companies, registered investment companies, big pension plans, corporations, things like that.
So institutions mainly.
Primarily, yes. Second, the buyer has to be purchasing for its own account or for the account of another QIB. And third, this is the big one, the buyer must own and invest on a discretionary basis at least $100 million in securities of issuers that aren't affiliated with the buyer.
Wow. $100 million.
Oh, yeah. It sets a high bar. They're expected to have the resources and expertise to do deep due diligence on their own. And here's a crucial point. Under no circumstances is an individual person, no matter how wealthy, considered a QIB. It's strictly for institutions meeting that $100 million threshold.
Okay, that really clarifies the different lanes for private offerings and resales and how the rules adjust based on who's buying. Now, let's shift slightly. Moving beyond standard new offerings, what's Rule 145 about? I heard it involves reclassifications. Sounds like it deals with existing securities changing form somehow.
You're right. Rule 145 addresses situations where a company's existing securities undergo pretty fundamental changes. Under Rule 145 of the 33 Act, certain kinds of securities reclassifications are actually treated as sales for regulatory purposes. And because they're considered sales, they are subject to the registration and prospectus requirements of the Act.
Why is that?
Because these actions essentially force shareholders to make a new investment decision. Examples would be an issuer substituting one security for another, or a merger or consolidation where shareholders exchange their stock in one company for stock in another, or even a transfer of assets from one corporation to another if it involves issuing new securities as part of the deal. But it's important to know what's not covered. Routine corporate actions like stock splits, reverse stock splits, or just changing the par value of a stock, those are specifically excluded.
Ah, okay. Because they don't fundamentally change your investment decision, just the number or denomination of shares, maybe.
Exactly. They don't typically require a new vote or investment choice in the same way a merger does.
Got it. That's interesting how certain corporate changes trigger those rules. What about Rules 147 and 147A? These sound like they're about keeping it local interstate offerings. Why would a purely local offering get a federal exemption?
Yeah, that's a good point, and it highlights the balance between federal and state securities laws. A federal registration exemption exists for securities sold only within the borders of a single state. The key is that instruments of interstate commerce, like national advertising or selling across state lines, can't be used to offer or sell them. The idea is if a company is genuinely doing business locally and selling its shares only to residents of that state, it's primarily a state matter, not requiring federal SEC registration.
But they still have to register in that state, right?
Oh, absolutely. They must comply with that state's specific securities laws, often called blue sky laws. The federal exemption doesn't remove state requirements.
Yeah.
And to qualify for this federal exemption, the issuer has to prove it's genuinely an in-state business. They need to meet one of four criteria. For instance, at least 80% of its gross revenues have to come from operations within that state, or 80% of its assets are located there, or 80% of the offering's proceeds will be used in that state, or alternatively, a majority of its employees are based in state.
So they have to be substantially local.
Exactly. It prevents companies from just setting up a mailbox in a state to try and dodge federal registration. There are also rules around ensuring the buyers are truly residents. Issuers use a reasonable belief standard, often getting written confirmation from the buyer. And for companies buying, their residency is determined by their principal place of business. Plus, there's a restriction. Purchasers can't resell the securities to someone outside the state for 6 months. That used to be 9 months, but it was shortened. And similarly to restricted stock, these securities need a legend clearly stating the resale limitations.
Okay, so these different exemptions and regulations offer distinct pathways, different lanes for companies raising capital. Now let's connect this back. A really prime example of an exempt security, but one with its own very detailed offering process, has got to be municipal bonds, right? Cities, states, counties use them constantly to fund infrastructure, schools, you name it. They're exempt from 1933 Act registration, we know that. But again, that core anti-fraud provision, that still applies.
Absolutely right. It's worth repeating. The anti-fraud rules always apply, even to munis. You can't lie or mislead investors. And yes, municipal securities have their own unique regulatory world. The Municipal Securities Rulemaking Board, the MSRB, acts as the self-regulatory organization, the SRO, for firms dealing in munis. They're the ones who write the rule book for how municipal underwriting and trading happens.
Okay, so within munis, what's the key difference in how a city or state would issue, say, general obligation bonds, JGONs versus revenue bonds? I know GOs are backed by taxes and revenue bonds by project fees, but how does that affect the actual issuance process?
That backing is the fundamental difference, and it drives the process. Grow bonds, because they're backed by the issuer's full faith and credit, essentially their taxing power,
Yeah,
they almost always require voter approval. People have to agree to potentially higher taxes down the line.
makes sense.
And their issuance is usually subject to statutory debt limits. The municipality generally can't issue debt beyond a certain ceiling. Revenue bonds are different. They're backed only by the revenues from a specific project or facility, like tolls from a bridge or fees from a water system or patient bills from a hospital.
So no direct taxpayer backing.
Correct. Because of that, they typically do not require voter approval. However, before issuing revenue bonds, there's a critical step, a feasibility study. This involves, usually, a consulting engineer looking at the project's viability and an accounting firm analyzing the financial projections. They need to determine if the project is likely to generate enough revenue to cover all its operating costs and pay back the bondholders. It's all about proving the project can stand on its own financially.
Right, so once a municipality decides, okay, we're issuing bonds, how do they actually pick an underwriter to sell them? Is it just choosing their favorite bank, or is it more formal?
It's definitely formal. There are two main ways. One is a negotiated sale. Here, the issuer directly selects an underwriter or a team of underwriters, often based on an existing relationship or maybe specialized expertise needed for a complex deal. They negotiate the terms directly.
Yeah.
The other way is a competitive sale. This is more like an auction. The issuer publishes the details of the bond offering and invites underwriters to submit competitive bids. Usually, the bid offering the lowest net interest cost to the issuer wins the deal.
So lowest borrowing cost wins.
Typically, yes. And often, especially for complex deals, the issuer will hire a municipal advisor. This is an independent firm that advises the government body on structuring the deal, timing it right, selecting the underwriter, basically, helping them navigate the whole process and act in their best interest. Now, just like in corporate finance, when underwriting munis, broker-dealers often band together to form a syndicate. One firm acts as the syndicate manager. And since municipal bonds are usually sold on a firm commitment basis, meaning the syndicate buys the entire issue from the municipality and takes the risk of reselling it, the firms involved need solid financial standing.
So they're on the hook if they can't sell them all.
Exactly. The syndicate manager has specific duties under MSRB Rule G11, things like keeping track of all the sales, running the pricing meetings where they decide the final yields, and maintaining detailed records like the settlement date with the issuer and how the bonds were allocated among syndicate members. For a competitive sale, the manager uses a syndicate letter to invite firms to join. For a negotiated sale, the governing document between the underwriters is called the Agreement Among Underwriters.
Got it. And what about the actual documents involved in a muni offering? Is there something like a prospectus that explains everything to potential investors?
Excellent question. Yes, there are key documents. For a competitive sale, the process kicks off with the issuer publishing a notice of sale. This is basically an advertisement telling potential bidders everything they need to know to put together a bid the amount, the maturity structure, how bids should be submitted, etc. Then a really critical document for every municipal issue, whether competitive or negotiated, is the legal opinion. This is drafted by a specialized law firm known as bond counsel. Their opinion confirms two vital things. First, that the issuer has the legal right under state and local law to actually issue the bonds. And second, that the interest paid on the bonds is exempt from federal income tax, and usually state tax too, if bought by a resident. That tax exemption is a huge selling point for munis.
Absolutely crucial for investors.
And yes, to your question about a prospectus equivalent, that's the official statement, or OS. This is the primary disclosure document for municipal offerings used in both negotiated and competitive sales. It serves the same function as a prospectus in the corporate world, providing detailed information about the offering and the issuer. But because munis are exempt from the 33 Act, the OS is not filed with the SEC.
Okay. Similar purpose, different filing requirement.
Exactly. And if an issuer prepares an official statement, MSRB rules require underwriters to distribute it to investors by the settlement date. These documents are incredibly comprehensive. They typically cover at least 15 major content areas, details on the offering terms, the purpose of the bonds, the security backing them, a description of the issuer, the government entity, financial information, project feasibility studies if it's a revenue bond, legal opinions, tax status. It's a lot of information.
Very thorough.
Very. And an important point. If a brokerage firm takes the OS and creates, say, a shorter summary or abstract of it to give to clients, that summary is then considered advertising under MSRB rules and needs principal approval before use. Now, getting that information out there efficiently is key. That's where EMMA comes in the Electronic Municipal Market Access System. This is governed by MSRB Rule G32. MMA is the MSRB's official online source for municipal market data and documents. It's free and available to the public. Underwriters and issuers submit documents like the official statement to EMMA. It's designed specifically with retail, non-professional investors in mind, giving them free access to official statements, real-time trade data, credit ratings, educational materials. It's really a fantastic resource for transparency.
So anyone can go look up info on Emma.
Anyone. And because of EMMA, broker-dealers can now just send customers a notice about how to access the official statement on EMMA rather than mailing a bulky physical copy. Though they must provide a punted copy if the customer requests one.
Okay, one last detail. I often see the CUSIP number mentioned with securities. What exactly is that?
Right, the CUSIP number. It stands for Committee on Uniform Security Identification Procedures. It's basically a unique 9-digit alphanumeric identifier, like a serial number assigned to each specific maturity of a security issue. So if a bond issue has multiple maturity dates, each maturity gets its own CUC. It helps track trading and settlement accurately.
Got it. A unique ID.
Exactly. And underwriters have specific deadlines for applying for these CUSIPs, depending on the sale type, negotiated, competitive, or if a financial advisor is involved. And finally, when you actually buy bonds from a new municipal issue, your broker needs to send you a final new issue confirmation by the settlement date. This confirms the details of your purchase. And along with that, you should get access to the official statement. For negotiated sales, the confirmation also has to disclose key pricing details, like the underwriting spread, any fees paid to the underwriter acting as an agent, and the initial price or yield at which the bonds were offered to the public for each maturity. Transparency on costs.
Wow, okay. What a journey we've just been on. We've really navigated the intricate world of securities offerings. We explored these different pathways companies use to raise capital, from understanding why certain securities and offerings are exempt from that full SEC registration, to the detailed rules around private placements, Reg D, accredited investors, then the resale rules under Rule 144, that interesting PIPE market, and the fast lane of Rule 144A for QIBs. And then we took that really deep dive into municipal bonds, seeing how their offerings are structured with their own specific set of rules, the difference between the get-go bonds backed by taxes and derivative bonds needing feasibility studies, the underwriting process, negotiated versus competitive sales, and the crucial role of documents like the legal opinion, the official statement, and that public portal, EMNA.
Yeah, and I think if we connect this all back, right, to the bigger picture, it's really clear that even with all these exemptions and specialized rules, that underlying principle holds. Investor protection through information and those vital anti-fraud rules, that remains constant. It really speaks to the complexity and the nuance of the financial world. These regulations, while they seem incredibly detailed, are ultimately designed to strike that balance. efficient capital formation on one side, making sure companies can grow and fund projects, but ensuring investors have the information they need and are protected from fraud on the other side. It's really a system built on layers of disclosure and trust, with that fundamental truth-telling requirement, as we said, as its bedrock.
So, thinking about all this, what does it mean for you as someone trying to understand or participate in the financial landscape? Maybe consider how these diverse rules and pathways we've discussed reflect this ongoing societal effort, really, to define what makes a transaction fair and informed in a market that's always changing. How much information is actually enough information? And who gets to decide that? What does all this mean for the future of investing, especially as information becomes arguably even more accessible or maybe sometimes even more overwhelming? Think about how these regulatory lanes might need to adapt to things like new technologies, new types of investment vehicles, and what that can mean for how capital flows, and potentially for you in the years ahead.